another chart. Just take a look again. You can see it's a very similar type of situation. We establish that opening range as the price is drawn up and down to take out those orders, and then finally the price takes off and its first major directional move of the day, and sometimes those can be pretty significant moves. So that's basically Big Ben in a nutshell. That's our first trading strategy of the day. And what I want to talk to you about now is Fibonacci retracements. And this has become a favorite of mine. It's kind of an interesting subject because, well, you'll see what I mean in just a minute. I want you to know that whenever I traded equities, there really wasn't a lot of talk about Fibonacci retracements, and it really wasn't taken that seriously. When I got involved with Forex, I was very, very skeptical of the entire idea behind Fibonacci retracements. But what I came to see over time is that they do tend to work in Forex. And so I'll show you what I mean. It's made a believer out of me, and it's certainly something that we can use to take advantage of and turn some profits. So the way that we come about this, about 900 years ago in Italy, there was a gentleman named Fibonacci, and he was a mathematician who was famous for several innovations. But what he's really remembered for is that he discovered certain numerical relationships that occur again and again throughout nature. He found these numerical relationships in music and architecture and reproductive rates and anything else you can think of in nature. And somehow this has been translated over into trading. Support and resistance is supposed to be found at key levels based on Fibonacci ratios. The key Fibonacci retracement levels are 38.2%, 50%, and 61.8%. So let's see exactly how this would work, and then I'll explain to you why I believe it works. First of all, for a long setup, we're going to draw a trend line from a significant low point to a significant high point. Then we're going to insert the retracement levels, 38.2%, 50%, 61.8%. That's very easily done with most charting packages. You can just click where it says Add Fibonacci in most cases, and it'll put those levels right in on that trend line that you've drawn. Then we're going to enter long when the price reaches a retracement level. Okay, so we've entered long. We're going to place a stop underneath the retracement level. Generally, I will risk no more than 50 pips, because if that retracement level is cleanly broken, there's no guarantee that that retracement level is going to hold as support. Once it's cleanly broken, I'm out of there. I don't want to be long something if it's breaking through support. But assuming that the trade works, if the position is profitable by the amount that I've risked, I will now close half of the position and move my stop to break even. Okay, and of course, I still have now, I've locked in a portion of the profit. I still have a portion of the trade open. The stop's at break even. If it goes in my favor, fine, I'll try to trail that stop along and maximize the gains on that portion of the trade. If the price goes against me, then my stop will be hit, but it'll be hit at break even, and I will already have locked in a portion of the profit. So let's take a look at a chart here, and what you're seeing, this is on a daily chart, and this Fibonacci, so each one of these candles represents one day. Keep that in mind, it's very important. We're talking about covering a lot of ground here, from that low point to that high point. And then the Fibonacci levels are inserted. You can see those three horizontal lines on your chart. That's where the Fibonacci levels are inserted. And so you can see that the price, after a huge rally, it falls back and it retraces, right? And where does it find support? Right at the 38.2% level. Why did it stop there? Is it a coincidence? Maybe. Let me explain to you why I think it stops there. Okay. First of all, if you've ever heard of the term self-fulfilling prophecy, that's why I believe that Fibonacci works. I'll give you an example. Suppose that this Fibonacci level is formed over a long period of time, and it certainly is. It's formed over weeks and months. Okay, so really a lot of people have been following this situation. A lot of people have had the opportunity to draw this same line. I'm sure that on trading desks around the world, there were many different traders and other people who drew the same Fibonacci line. They came up with the same Fibonacci levels. And so if everyone assumes that there's going to be support at the 38.2% level, what are they going to do when the price reaches there? They're going to buy. If there's enough buying pressure at that point, that will in fact force the price to go back up. There's your self-fulfilling prophecy. In other words, in a sense, it found support there because enough people believed that it would find support there and placed their orders accordingly. That could be one explanation for it. So personally, I'm a skeptical person. I don't believe there's any type of anything such thing as a magic number or a magic ratio. But what you'll find is that Fibonacci retracements are part of the culture of Forex trading. They're very widely followed, and because they're widely followed, anything that's very widely followed has the possibility of becoming what we call a self-fulfilling prophecy. So we're going to take a look now at a short trade using the same type of situation. Same thing, we're going to draw a trend line from a significant high point to a significant low point. Next, we're going to insert those same retracement levels, 38.2%, 50%, 61.8%, and then we're going to enter short when the price rises to a retracement level because we believe it might find resistance there. Once we've reached that resistance level, we're going to place a stop 50 pips above that level, no more than 50 pips above, because again, if it's cleanly broken, we don't want to be short. And obviously, when our position is profitable by the amount that we've risked, again, we're going to close half of the position and move our stop to break even on the rest of the position. And of course, if the price goes against us, we'll be out at break even on the second part of that trade. If the price goes in our favor, we'll trail that stop along higher, and lower in this case, I should say. And here we go again. We see again, we're drawing the Fibonacci level, and again, very important, it's on a daily chart, right? It covers a long period of time. It's a significant move from a high point to a low point. So enough people have had a chance to see this and act on it. The price comes up, and yes, it does break through the 38.2% level and the 50% level. And if we were going to enter based on those two, we would have lost based on those two trades. But it does find support right at the 61.8% level, and over the next week or two, the pair, actually the exchange rate drops about 900 pips. Really a kind of a spectacular fall, and it just happens to choose that point to find resistance and turn around. Okay, so make of it what you will. Is it science? Is it magic? Or is it a self-fulfilling prophecy? Doesn't really matter if it works. Okay. Now you can use Fibonacci intraday. I'm going to give you an example of that. I want to tell you that I'm a lot more confident over Fibonacci levels that are created over long periods of time. So I prefer to find them on the daily chart or even the weekly chart because of the same reasons that we spoke about earlier. If indeed it's a self-fulfilling prophecy, then doesn't it make sense that the more people that see this, the more people that draw the same line that you draw, the better that it may work? And it just stands to reason that less people are going to see the intraday setup, so it probably has a little bit less chance of success, and I want to risk less on that trade too, because when you're trading Fibonacci in shorter time frames, you have to use tighter stops. Why? Because the profit potential in most cases is also going to be less than it is on the daily chart. So let's take a look at the intraday setup here, and you can see that we draw from a significant low to a significant high point, and we get multiple opportunities to enter at the 38.2% retracement level. The price pulls down to that 38.2 level, bounces off of it a couple of times, and then takes off. So yes, can this work intraday? Sure, it can work intraday, but would I prefer to do it on a daily chart or a weekly chart? Absolutely. And the longer period of time that is covered, the more important, the more significant that Fibonacci level is considered to be. So we're going to take a look, okay, that covers Fibonacci. We're going to take a look at channel breakouts now. And what we're attempting to do with a channel breakout, we want to identify situations where the price is trading within a narrow channel. This is going to be on an intraday basis. So when I say a narrow channel, I don't want it to be more than, say, 25 or 30 pips. I really want the price to be in a narrow range, preferably even more narrow than 25 or 30 pips. And what we're going to do, we're going to trade in the direction of a breakout from the channel. Now, why does a